Ajay Srivastava is joining us on the phone line from Dimensions Corporate Finance. Of course, needs no introduction. Ajay, you would think the reason for calling you today is simply this. After such a bad day yesterday, there might have been a technical rebound, yes. But the more important thing, the last 2 days, we've heard a number of market voices and a number of corporate voices saying that it's not all lost. Market voices are saying these are good times to maybe buy select pockets, and there are corporate voices who are coming and saying that it's not all gloom and doom. Growth is visible in their sectors.
See, three things, Neeraj. One is that and we would call when you have a sales loss of 30, 40, 50% in key sectors, what has come about, it is not an ordinary correction. And I think we must realize that something serious is happening underlying the economy. It is not something every day that companies report 30, 40, 50% shortfall in sales. That's one. Number two is, I think it's important that the big honchos of this country obviously needs to inspire confidence. There is no point of creating a panic in the market of the economic prospect because that's counterproductive. And they would need to and perhaps are working in tandem with the government to reassure that things are okay or things will become better and so on. So one would not expect anything different, that they have to say this to keep the confidence going. Some may genuinely feel it, some may not. But the fact remains that as a community, this is the time they have to get together and back up the government, whatever the economic scenario is. And number three is, it is running absolutely straight to the definition of what happened post-demonetization is that as the competition from smaller companies disappeared, you were discussing paint just before I joined in, there were hundreds of smaller companies who used to cater to this market. They've all but disappeared. And therefore, while the economy may not show the growth, some companies may do show some growth in terms of sales. So you will find that aggregate sales may still be lower or maybe negative, but some companies may find a good growth because a lot of supply from smaller companies is now disappearing. So economically, what's happening is pretty bad, but some companies' results could give you the idea that all is not lost. But it's not a good time. It's dangerous time because these kind of 30, 40, 50% falls, do not kind of reflect that something is very, very temporary at this point of time.
For someone who's actively looking at their portfolio, they need to do something, right, Ajay? I mean, you can't just sit on cash. You probably need to churn that trade out. So, I mean, for someone who's been saying that they've been buying since the last few months when the market has started to slip, what would the strategy be now?
See, first of all, nothing wrong in sitting with cash. I think we should all learn from Warren Buffett. He used to sit with cash and kind of invest, although he hasn't done too well in the last 5 years or so. He has not beaten the index, but leave it aside. His trajectory is that you need to have cash to buy for a rainy day. Maybe is this the rainy day is the key question. And I would still say that if you are looking at your portfolio, you would do what is required is please gravitate towards market leaders in any industry that you like. If you are hoping for an alpha return from a small cap, I think that's one which is not going to turn out. And that trade could be a bad trade. And we have seen it's like old terminology, the falling knife. You don't know till the share price goes to 6 rupees and 5 rupees and thereabouts. So I think one key element of this market is, and the economic policy put together, is that you will not place your bets on any small or mid cap for a dramatic turnaround to your portfolio. You have to stick to the larger caps, because they are the only ones which will grow. Even if economy turns around, and 1 or 2 days you might find a burst of share price, but that's only going to be sold into by people who are stuck in small and mid caps, because fundamentally and economically, the rationale for smaller mid cap is not any positive anymore in the economy. So if you are looking at a portfolio and you don't have large caps in every sector, I think that's where you need to gravitate. It doesn't matter what loss you book.
Right. In fact, Ajay, we were talking to a very revered technical analyst in the morning, and he was of the opinion that these are not corrections in the market because the structure of the market only itself looks like we're already in some sort of a bear market. While the index is down about 10 or 12%, the broader market space has been butchered. So in light of that, I mean, even when you're taking a look at, these small bounces that keep coming your way, one cannot really take a call and say, all right, things are turning around materially.
See, the call has to be taken on two respects, and I think a very important call has to be taken. One is that the next turnaround will not happen because of government policy. The next turnaround will happen because we will have substantial buying by the FIs. I think that's where the call is going to come from. Domestically, I think by and large, Indian public is overinvested. and at this point of time, and most would be willing to kind of just get rid of some of the portfolio. So number two is economic policy changes can't happen, and even if they happen, the impact will not be overnight. So I think one key trigger for us is, will their buying come through from the overseas side? First, of course, selling has to stop, and then buying commences. And I think that's where you will get some confidence that you should be a buyer and rebalance your portfolios or average out, whatever you call it. But you need to wait the foreign buying trigger in a market like this. We have seen so many government announcements. They came, short burst, and then the market disappeared. So I think now economic fundamentals have played the course. Now you got to wait for a big trigger from overseas to start buying, and only then you should be in the market to buy. Just be simple. If they are buying, we will buy. If they are selling, we will sell. If they are selling, we may not sell, but certainly we will not buy when they are selling.
Ajay, then would that also mean that this could be a protracted period of pain, since you're saying we need to wait out for FIs to buy, who've already sold, by the way, nearly 30,000 crore in the month of July and August, despite of FM announcing rollback of higher surcharge on FPIs, they continue to sell into the markets. I think there was just one day when there was some buying figure which came in. So domestically, do you think there's no trigger left for FIs to buy, and now globally something has to happen?
Well, theoretically, anything can happen domestically. Government can change the policy tomorrow and says we will sell our PSU banks to the strategic buyers, and the mood may change dramatically. But fundamentally, unless the economic policy runs in tandem with genuinely what should be changing in the economy, all these announcements will not come to much fruit. So I say, I can't say one way or the other. I said tomorrow the announcement comes that we will do a strategic sale in PSUs and PSU bank. I think it will be a great positive and foreigners will buy it. But if you say I'm merging the banks and I'm not going to let a job be lost, then the very purpose of merger is lost as per global standard. The idea of merger is to get synergies and cut the cost. And manpower is the biggest cost in bank after interest cost. So if you say I'm not going to cut that, then the merger doesn't make sense. So if you are able to put in policies which are market related, I think you can change the mood domestically. But otherwise, I think we need to just wait it out. That's one. Number two, at some point, and let's be honest about it, share prices will reach at some point, like for instance, you see metal companies, NALCO, NMDC, etc. have already reached a point where intrinsic values are reflected in the share price at the lowest level. You can't go below that. So unless share reaches that level, then of course you can not sell, but certainly buy decision can be good. If you look at Maruti, it's already about 3x book value, and if you take out the bank balance, it will be about 2.5x book value. Maybe another 20% correction, and then you reach intrinsic value of the stock. So I think we are reaching at a level where selling doesn't make too much of sense. Now buying trigger comes from the overseas buyer. That's our point.
Enough, Ajay. In fact, a lot of the market experts have been highlighting how markets are oversold, and point well taken, but the banking officials are of the view not to solely look at the employee cost when you look at the cost synergies of these mergers. But nevertheless, last question from my end, how do you identify the turnaround then? Do you then wait out for markets to go up, earnings to improve, or for that matter, I think the chatter around the auto space, the monthly sales number to improve? For a couple of them, I think on month for these two-wheelers, we have seen a tad bit of improvement.
See, as I said, economically, it would be really, I'll be ambitious to say there'll be a dramatic turnaround and this will happen, so that leave it aside. I think you need to do two things. Forget the share price for a minute and look at your portfolio and says, do you have the top 5, 10 best performing companies in the country in a portfolio or not? If you don't have it, this is as good a time to have it. And if you really want to buy big, then wait for the FI trigger to buy big. But I still keep saying that any point of time, you need to keep those 10 best companies of India in your portfolio. There is no timing for that. If you have it, then you stay put. If you don't have it, buy them. But big trigger will come when the FIs change course, because they will make the difference between the market liquidity and the demand supply.